So you're gainfully employed and you feel like you pay way too much in income taxes, and you're wondering what sort of strategies you should be employing to try to minimize the amount of income taxes you're paying. Well, we're here today to discuss two areas that you should be thinking about as it relates to your employment and through your payroll, and another two areas that you should be thinking about just in general on your personal tax return. Now keep in mind, all of these things we're going to talk about, we're fairly limited as the IRS doesn't give us a lot of tax loopholes, unfortunately. So the first item we're going to talk about relates to does your employer offer you a qualified retirement plan, a 401k or 403b or 457b plan, which is called a deferred compensation plan. If they do, we would recommend that you maximize your pre-tax contributions into those plans, and you want to understand what your annual maximums are because they're different for somebody over the age of 50 as they fall under the catch-up provision rules than they are for someone under the age of 50. The second item through your employer is, do they offer a high deductible health care plan? If they do, we would highly encourage you to look at utilizing that because it would allow you to put pre-tax dollars away into a health savings account, which is very powerful. Health savings accounts are the only triple tax-free type of account we know of. And if you don't need the dollars in this calendar year for any out-of-pocket healthcare costs, your health savings account continues to be there for future healthcare costs, and it continues to grow tax-free. Now, as it relates to that, sometimes employers also offer flexible spending accounts. So if you have that available to you and you have like daycare costs and things of that nature, definitely make sure you use the dependent care flexible spending account because it allows you to pay for your daycare using pre-tax dollars. That's very powerful. But keep in mind, flexible spending accounts must be spent in the year that you defer them out of your pay stub, otherwise you forfeit those dollars. Now, the two items on your personal tax returns relate to one, do you have any dollars saved up outside a retirement account, inside a brokerage account? If you do, you're getting a 1099 on that account every year, so we would advise you to use a passive investment strategy versus an active investment strategy. Active investing means that you're buying and selling a lot, and anytime you sell, you either sell at a tax gain or a tax loss, and those sales are accumulated on a 1099, and you have to report that every year on your tax return. So a passive investment strategy is much more tax friendly. The last item is, are you charitably inclined, and how do your standard deductions look versus your itemized deductions? The tax law changed in 2018, and now many of us are using the standard deduction versus itemizing. Well, if you still look at these, if you're still charitably inclined and these two dollar amounts are pretty close, you're going to want to lump your charitable contributions that you normally make into one tax year. So if you give $1,000 a year typically to charity and your itemized is real close to your standard, why not put $5,000 into a donor advised fund in 1 year, lump it in 1 year, which then allows you to take the itemized deduction versus standard. And what a donor advised fund allows you to do is to give the dollars out to charity over time, but when you deposit that $5,000, you get to deduct it at that point. So it's a very powerful strategy that allows you to feel like you're getting a tax deduction for your charitable contributions, even though you take the standard deduction in many years. So hopefully these tips have been helpful to you. If you have any additional questions, please feel free to reach out. Thanks.